So, how does our business work, right? I think it's important that you guys understand that some of this is our money, but a lot of this is somebody else's money, right? And so why is it important to know this? Because then you don't waste a lot of time talking to the wrong fund. You don't waste a lot of time saying, look, if I had started, I'll get there in 3 months. So I'll take you through the cycle time. And then you'll also get a better handle on who to go after for money, right? That's very important. So our business, typically in the venture model, people talk about a fund life, right? So a fund typically has a 10-year life cycle. In the first 3 or 4 years, we actually invest the money, right? And then at the back of that period is when we start to return money to our investors, right? Because they say, look, here's some money. And they look at their entire portfolio like you would, and they will put some money into bank deposits, they'll put some money into public markets, and they'll put some money into us, which is the highest risk and potentially the highest return asset class for them, right? So when they look at me, they don't look at me and say, give me 10% or 12%, right? When they look at us, they expect, double digits, right? 20, 25%. Then you take in the added burden of, India volatility, currency volatility, and the bar gets higher and higher, right? So a typical venture fund, if it's not returning 18 to 25%, is out of business, right? So our industry is also, I think in some ways, self-correcting and self-policing. Very few venture funds, are perpetual. If they deliver, they get to raise their next fund. If they don't deliver, they don't get more money, right? So we are also startups in some way, right? We don't get perpetual capital to do what we do. And generally speaking, every fund does require one big hit in any fund to actually make meaningful returns. So you've heard about the 10-bagger and the 20-bagger. It is true, you need those because you will lose some as well, right? So our model only works if we build, one Amazon, hopefully not one Groupon, but a few other businesses like that, right? So, what are the sort of implications for you, right? When you talk to us, the thing that we need to assess is, look, is this a 5 to 10x type of return opportunity? So if I put in 10 million, will I get 50 to 100 million back? Right now, it's hard to sit here and imagine building, 100 million in equity for me because, at the finish line, investors may own about 25% of your business. So you will need to create $400 million of equity value, right? So it's not just about saying, look, how do I return 100? It's about how do I create 500 because that's the size of the pie that we need to create, right? It typically works with large exits and large exit we will define in the three digits, right? So if somebody says, look, I'll take my company public, for 100 million, generally that doesn't get VCs excited. Now, I'll caveat this by saying, different fund sizes have different economics. But generally, most VC funds allocate between $50 and $60 million per professional. So if it's a larger fund, they'll have more investment professionals. If it's a smaller fund, they'll have fewer investment professionals. But order of magnitude, each investor typically manages $50 to $60 million. Sorry, the only other thing I will point out is that our model typically works if we get meaningful ownership, right? Now, this works in two ways. One is, we have this conversation about valuation, which we will address a little bit later on. But I think it also creates for alignment of interest. So if on day one, we don't own enough of your business, you're not going to get enough of our time. And if you don't get enough of our time, you're probably not going to be important for us. So then you don't get all of the ecosystem, you don't get the relationships. So just bear in mind that you want to have a healthy ownership for your VC. Otherwise, you're going to be their 9th company or their 10th company. And some of you it may be fine, but for a lot of our companies, that active involvement is very important.